Hello, hello, hello. Welcome back. Welcome back to my channel, The Cheryl Hubbard Show. Glad you could be here. Glad to see you. Glad you could join me. So today, previously I did a video, in the past I did a few accounting tutorials, but then just recently I did, excuse me. So recently I think maybe a day or two ago, I did another accounting tutorial. So these are actually this is actually my second one this week, and excuse me. So actually, these are the first two that I've done since I purchased my ring lights. So that's what I wanted. So I have two ring lights, so it gives me a clearer picture. And then I have one in the back. But I know when I first started my channel, I did my little accounting tutorials, and I didn't have my ring lights. But I went on and purchased two ring lights from Amazon, and I find that they do, it does give me a brighter atmosphere, a brighter room. So I have my ceiling light, and then I have two ring lights. But okay, so glad you could join me. Glad to see you. Glad you could be here, and welcome back to my channel, The Cheryl Hubbard Show. And so I just want to go over a few things. So this would be just a little accounting recap, an accounting tutorial, a little recap on, just probably some debits and credits and T account debits and credits, and just explaining a little bit what accounting is, who needs accounting information, who needs accounting information, who uses accounting information, what is accounting. Then we'll go into our defining liabilities, owner's equity, debt. What is a debit? What is a credit? What is accounts receivable? What is an accounts payable? What is what consists of what goes into the revenue accounts? Then we also have you have different accounts. You have your cash account as well. You have your supplies account, your cash account. So, just thinking off the top of my head, cash account, supplies account, inventory account. You also have a land account, building. So all those are asset accounts. You have land accounts, building accounts, accounts receivable accounts. Those are asset accounts. You have your cash account, supplies, inventory. So for instance, you want to buy some land, you want to buy a building, all those are considered asset accounts. So first of all, let's start out with what is the definition of accounting. Accounting is a system that measures business activities, and take those activities are, gathered up, and then reports are made. So once reports are made, those reports are made for decision makers. So in other words, you take your activities, you measure it. It's a system that measures. So I had a video previously on my channel that I made. I talked about those information systems. So an accounting system would be an information system. So you are gathering that accounting information measured. You're measuring the business activities through the business activities. So through your business activities, your business, somebody else's business that you're working for, you may be a manager, you may be a CEO, you might be a certified public accountant, but you have a system that you go by, and you have a system that you go by, and you want to measure those business activities, gather all that information, make it into reports. So decision makers, like your decision makers from your based on your, I guess I would say, financial accounting records, and managerial accounting records. So your financial accounting records, there would be information that you would use for your outside decision makers. So in other words, your financial accounting, your SEC, your auditors, your bank account, your banks, your creditors, they all need information. They want to know how your business is doing. So in other words, what if you are looking for a loan? You want to buy some inventory on credit. What type of credit do your business have? Do you have your bank statements? You have your bank statements. You have your income statements. You have your statement of cash flows. You have your balance sheets. Your balance sheets will consist of assets equals liabilities. Assets equals your liabilities plus your owner's equity. That goes on your balance sheet. And then on the income statement, you have your revenues minus expenses will equal your net income. So in other words, your net income would tell the story of how your business is doing, how's this company doing. You want to borrow, say for instance, you're a McDonald's, or say for instance, you're my company, Shirley Cosmetics, or you running a t-shirt and jean business, you running whatever business you're running. You're selling mainframes, you're selling mini computers, Mac mainframe computers. You selling desktop computers, laptops, tablets, whatever business you have. You want to know how your company is doing. So that's why you need to have uh, accurate reports, accurate statements, accurate income statements, balance sheets, statement of owner's equity. All those statements need to be accurate. Needs to be done accurately. So you can either outsource, and you may outsource and have another accounting firm do your accounting books, or you might do it in house, but you might have your own accounting department. Or if you're a small business, you may be owning. You probably can be doing your own accounting books yourself. So that's why I always said it's good to learn accounting. I feel we all should know the basics of accounting. I know when I first started taking accounting, Strayer University, right here in Washington, D.C., I didn't know what accounting was. I didn't know what it was, so it's really not math. It's not even considered math. But you do have to add, a few figures here and there. Say for instance, um, you're trying to add up your revenues. In other words, you might have to do it, like I said, you still might have to add a few figures here and there. What if you were running a salon or a barbershop, you're cutting hair? You still might have to add up your revenues. I mean, how much did we make when we cut 4 or 5 people's heads of hair? How much did we make? We cut 10 people's hair that day, and we made, say for instance, we made 500 just by cutting somebody's hair for that day. And then we trimmed somebody's hair, we cut somebody's hair, we did a perm, we did shape ups, we cut off beards. We made $1,000 for that particular day. Yeah, so then how much did you make the second day? Oh, we made $2,000. We cut about 50 people's hair. We cut their hair, we trimmed their hair, we permed their hair. Well, whatever we did, we made 1,000 one day, 500 the next day. So what's that? $1,500 in 2 days. So it does require some adding at some point in accounting. But accounting is mostly not math. It's not considered math. It's considered a system that measures business activities, and those activities are formed into reports. So they can be, when they are formed into reports, that makes it available for the decision makers to be able to read, and they have to be accurate. So that is what accounting is. And then we want to know who needs accounting information. So who needs accounting information? So basically, individuals, businesses, investors, creditors, government regulatory agencies, taxing authorities, nonprofit organizations, and also we have, like I said, financial accounting for the outside, SEC, Security and Exchange Commission. We have the Security and Exchange Commission. It's a federal agency that requires businesses to disclose certain financial information. So you work for a business, you have to disclose certain financial information because it has basically, from my understanding, a lot of that information is public record. you know. And it says, like many government agencies, the SEC bases its regulations in part on the accounting information it received from the firms. We have taxing authorities, non-profit organizations, other users are employees, labor unions. They say employees and labor unions make wage demands based on their employers' reported income. Consumer groups and the general public are also interested in the amount of income businesses earn. So we the public, we're interested in how much businesses make too. So like I said, and also if you want to make if you want to invest in a business, you want to buy stock in a business, we are interested. You would be interested in how their company is doing, how much are they earning. So in other words, you want to invest in Microsoft, Amazon, any of those companies. You want to know how are they doing. So those are the people that would be interested in accounting information. Individuals, businesses, investors, creditors. So you want creditors, investors. Say for instance you running a business and you working for that company and you want to like I said you want to borrow some money. You want to buy some more land. You want to expand your business. You want to buy some land. You want to buy. You want to hire some more employees. You want to buy some more inventory, some more company supplies. You want to open up a credit account with certain companies. So then they'll want to know how your company is doing. Can they, like my example I always give, McDonald's, Wendy's, Amazon. So, different companies. So, let's see. And then, let me see. Let's go into, liabilities. Let's go into, different terms. Let's go into different terms. So, first of all, I explain what accounting is, and then next, you go into the different terms before you get to your T accounts, because these terms are very important. So these are among the accounts that you will have. We have a cash account. We have liabilities, but it would be called accounts payable. So we would have payables. Then we would have receivables. We have payables. We have receivables. Then we also have our revenue accounts. We have our revenue, so we have something like, sometimes we may have service revenue, or we just may have revenue. So money earned. Money earned is your revenue. You go out there and work, you earn your revenue. Service revenue, like I said, you run in a salon, you run in a barbershop. You run in a salon, you run in a barbershop. You want cutting hair, you're doing perms. So let's start out with the cash account. So in other words, we have our cash account. So in other words, once you learn your terms, these terms can sink in, and they will become very valuable when you start doing your T account. So let's start out with the first T account. Okay, we have a cash account. In other words, you start the business. Say for instance you opened up a bank account with that business name. Say for instance my company, Shirley Cosmetics, LLC. Shirley Cosmetics LLC. I saved up enough money to open my business. I saved up, say for instance, I saved up $500,000. I saved $500,000. I want to open up a bank account in the name of Shirley Cosmetics LLC, because see, I want to separate that bank account from my personal bank account. So my personal bank account will come under my name, but my business bank account will be Shirley Cosmetics LLC, and I want to invest $500,000 in my business. So this will be Shirley Cosmetics LLC. And say for instance, I want to invest $500,000 in my business. That will come under my cash account. See, So when it comes to it, since the cash is an asset account, cash is an asset account, I want to debit on the left for increase. So when it comes to an asset account, you debit on the left for increase. So since I deposited $500,000 in my business, I'm going to debit on the left. Shirley Cosmetics LLC will go into my cash account. So that is an asset account. And then we have accounts payable. So we have accounts payable account will come under liabilities. All payables are liabilities. Like I said previously, salaries payable. So you have to pay your employees. That would be a payable. That's a liability. And so accounts payable, like I said, you're running a company and you want to go purchase from another company. You want to purchase from another company and you don't want to pay all the money at one time. You want to open a credit account. Say for instance, Shirley Cosmetics or whatever company, Coca-Cola company or Amazon, what do we have? Microsoft, whatever company we want to, put up in the equation. So we said, I will say for instance, I need all my oils. I need my oils, I need my oils. I need my jars. I need my jars. I need my labels. I need my jars. I need, plain jars. I need labels. I need my labels. I need oils. I need jars. I need labels. But I want a big supply. I want to see if I have enough credit, So that's what I'm saying. When those accounting reports are made available to the creditors, so they can, they want to see how my company is doing. I want to create a credit account. I want to, buy some supplies. I need about $100,000 worth of supplies. Like I say, my oils, my jars, my labels, because I make my company is Shirley Cosmetics, and so what I do in my company, I make body butters, hair growth balms, and body butters, hair growth balms, and lip gloss. Lip gloss tubes. I feel lip gloss tubes. So I need my oils, I need my base, I need my pipettes, I need my syringes, I need my glitters, my pigments, I need whatever I need. So if I don't have that credit, if my company does not have enough credit, I will not be able to get say for instance, I need a big supply of inventory. I need a big supply for my office. I need a big supply of inventory. I need supplies for my company so I can make my products, so I can sell to my customers. But if I don't have that credit, I won't be able to open a credit account. So open a credit account. But if I am able to open a credit account, I'll be creating accounts payable because I'm going to have to pay them. I'm going to have to pay the company. Say for instance, I purchased $100,000 worth of inventory on credit. I need my office supplies. I need my business supplies to operate my day-to-day business. But that will be an accounts payable. So I'm gonna have to pay them. But they will be creating an accounts receivable because once I start paying, they will receive the money from me. Accounts payable will go on my company books because I opened up a credit account and I have to pay them for the office supplies, business supplies that I purchased. So they're definitely going to look at my bank statements, my income statements, my statement of owner's equity, my statement of cash flows. They are going to want to look at that. So that comes under, I guess it took me a long time to explain it, huh? Accounts payable and accounts receivable, so that's the same. So that company would be creating an accounts receivable because they would be receiving the money from me that I owe them. And I will be creating on my company books. My company books would be an accounts payable. So say for instance, like I say, it's a T account. So accounts payable, say for instance, like I say, $100,000. I need $100,000 worth of office supplies. So I want to credit on the right-hand side $100,000 because previously in my other video, I explained that when it comes to a liabilities account, you want to credit on the right for increase. So I'm increasing my liabilities account by $100,000 because I purchased some office supplies on credit. $100,000. So that's how I create my accounts payable. So I create my accounts payable. So once I begin to pay my accounts payable, I debit on the left. But when I first create it, I want to credit on the right because I'm increasing my accounts payable account. So say for instance, I want to pay $50,000 on my debt. I debit on the left. I debit on the left, and then I still have a $50,000 balance that I owe. So that's how that would go. And then to create two, so it would go like this. If I initially create accounts payable, you always have two T accounts. So initially I created accounts payable, and then I have a cash account. Say for instance, I started $100,000. I created accounts payable $100,000 because, like I said, I bought the office supplies. So I want to debit. I want to credit. I want to credit accounts payable 100 because like I said, when it comes to a liabilities account, you credit on the right for increase. But when it comes to asset account, you want to debit on the left for increase. So it's like the opposite. Debit on the left for increase when it comes to an asset account like cash, but you want to credit on the right for increase. So in other words, I started with $100,000. $100,000. I started because I purchased some supplies for $100,000. So, so I want to credit my accounts payable. But what I want to do, I want to go back and pay $50,000. I want to go back and pay $50,000 on the $100,000 that I took out my credit on. That I created a credit account and I bought $100,000 worth of supplies, inventory, supplies for my business. I took out accounts payable for $100,000, but I went back and paid $50,000 on that $100,000. So my balance would be $50,000. So I have $50,000 left. But what happened was, since I paid $50,000 on my $100,000, it's gonna have to come out of my cash account. See? So I want to credit my cash account because I'm decreasing my cash account now. I want to debit, credit. I want to credit. Debit on the left, credit on the right. I want to credit my cash account, which is an asset account. I want to credit my cash account $50,000 because I took $50,000 out to pay on my $100,000 debt. So they give me $50,000 left. So that's how they go. You always have two accounts. So you took $50,000 and paid $50,000 on my accounts payable. So then the last one is revenue. I explained a little bit about revenue. So revenue, in other words, you have, like I said, you have, you run in a salon, you run in a, like I said, Shirley Cosmetics. I'm doing hot oil treatments. I'm selling products as well. I'm selling my label. I'm selling, not labels, I'm selling my hair growth balm, my body butters, my lip gloss tubes. I'm just selling the tubes and I'm selling the lip gloss once I fill the tubes up. So all that will come under my revenue. Revenue. So revenue, like I said, you run in a salon, you run in a barber shop, you cutting hair. All that's considered service revenue. You provide the service, service revenue. You could be a consulting firm, a law firm, a consulting firm. You are providing a service revenue. Service revenue. So that's what that is, So in other words, It's good to learn these terms, and that way when you learn these terms, so that way when you're dealing with the T accounts, it won't be so hard. In other words, like I said, we talked about the cash account, which is an asset account. We talked about a cash account, which is an asset account. We talked about well, let's do it like this. Accounts payable, which is a liabilities account. We talked about accounts payable. Accounts payable, we also, under that, we have a salary payable. And then we come under liabilities, and we have your cash account. So under your asset account, cash will come under your asset account. Also, you have your land, your buildings. So let's just do a couple of T accounts, and let's see. Let's do a couple of T accounts. Okay, the first one we said Smith invests $35,000. Let's say Smith invests $35,000. So what I say, always, it's a nice strong chalk. See, Smith invests $35,000. So we're gonna have to. Each transaction always affects two accounts. So if Smith invests $35,000 in the business, so $35,000 will go into the cash account and owner's equity. See, Smith invests $35,000. Cash is an asset account. We want to debit on the left for increase. Like I said, all asset accounts, you debit on the left for increase. Asset account is cash. We want to debit $35,000. We want credit. Owner's equity, $35,000. So that's the first one. So let's see what else we have. And then we have, she purchases on account office supplies. Let's do a different amount. Office supplies. Let's say Shirley Cosmetic purchases office supplies on account. Purchase office supplies on account. So I always make sure I do two. Office supplies on account. We're going to definitely go with office supplies. Office supplies on account. I probably would consider that, I would consider accounts payable. So office supplies purchase on account. So since accounts payable is a liabilities account, I'm gonna credit on the right $400. Say for instance I purchased $400 worth of office supplies. I'm gonna credit accounts payable $400, and then I'm gonna debit office supplies. Because I purchased office supplies. Office supplies is an asset. That means I purchased that asset. I purchased that asset, which is office supplies. So all asset accounts, I'm going to debit on the left for increase. So I increased my asset account, office supplies. Office supplies is my asset account. So I debit on the left $400. Credit on the right $400. Accounts payable. I didn't pay it all at one time. So I was talking about having that credit. Now I was talking about previously about having that credit. So I created a credit account for $400, and so I can purchase some office supplies for my business. Office supplies for my business. A lot of times companies won't give you no, credit unless they have unless you have a good standing with them. So a lot of times you can't just go and you can't go to a company and say, hey, I want to purchase these supplies. A lot of times it depends on the amount. I guess they may want to look at your bank statements, your income statements, your statement of owner's equity, balance sheets, statement of cash flows, and if it's a large amount. So like I was saying, like McDonald's or Wendy's or Amazon or somebody like that needs to, sometimes then, once you build your credit up, a lot of times they have certain suppliers and manufacturers that they deal with on a regular. And a lot of times, as I previously was reading, they have, you keep your track record up and you pay on time. A lot of times, you have certain companies that you deal with, they won't mind keep on doing business with you. They don't mind keep on doing business with you. So the next one is Smith pays $30,000 to acquire a lot of land. A lot of land. Okay. Smith pays $30,000. I always like to. So I can say Shirley Cosmetics or Smith paid $30,000 for a lot of land. LOT of land. So we're gonna go with land. Land is an asset account. I want to purchase some land for $30,000. The book says Smith, but I can go with Shirley Cosmetics. Shirley Cosmetics LLC. I want to purchase some land for $30,000. So if I want to purchase land for $30,000 in cash. So land, $30,000. If I'm purchasing land, I'm gaining an asset. So I want to debit cash, debit land on the left-hand side, but I want to pay cash. So I'm not creating an accounts payable this time. I'm paying cash out the company bank account. Shirley Cosmetics LLC. So I want to credit cash because it's coming out the cash account. $30,000. Cash is an asset account. Credit on the right for decrease, debit on the left for increase. So, but I want credit on the right because I'm taking cash out of the cash account to purchase this land. It cost me $30,000, so I'm acquiring another asset, and at the same time taking away from one asset, but acquiring another asset, which is land. And I'm paying $30,000 for it, and I took $30,000 off my cash account. So credit, I'm gonna credit my cash account. So that's that one. So I find that doing T accounts, that help me learn faster. Because when you do T accounts, sometimes you can do them separate, and then later on, you can practice doing them together. Because I think it's easier to learn T accounts separately. Because they seem rather, some of them are simple, but when you get to like the depreciation, accumulated depreciation, so maybe I'll do some of those on my next video. Okay, then we also have next, okay, it says Smith locates apartments and received $1,900. So I always start out with two. Like I said, everything. Smith locates apartments and receives $1,900. So it's almost like you have to read into the question. She locates apartments and she receives $1,900. So that would appear to me that she received some cash. So if she receives some cash, $1,900, that means $1,900 is going into her cash account. So cash is an asset account. I want to debit on the left for increase. So she received $1,900. She received $1,900 for locating apartments for clients. So she located apartments Then I had to think about what the second one would be. She locates apartments. She received cash for $1,900. So I would think that would be service revenue, because I feel that she performed a service. She located apartments for $1,900 cash. So I would still say I would put service revenue. Or if it's not service revenue, it could also be owner's equity. So if she received $1,900 cash for locating apartments, she performed a service. I guess I would call it service. It still was service revenue because, but I'm gonna put it under owner's equity, which would be $1,900. So $1,900. So cash is an asset account. I'm gonna debit my cash account $1,900 and credit owner's equity $1,900. So let me see what we have next. Then we have it says that Smith pays $2,000 for a vacation, but really that's not a business transaction. But if she paid $2,000 for a vacation, that's not a business transaction, but she still, I guess, could take it out of her cash account. She could probably still take it out of her cash account, so that's gonna have to come out. That still will probably come out of owner's equity. So coming out the cash account $2,000, and it could come out the owner's equity $2,000. So you want to credit the cash account $2,000 because she took $2,000 out for her vacation, and then take $2,000 out of the owner's equity. Or if it's not owner's equity, it also could be a withdrawals account. You can have a separate account for withdrawals and take out $2,000. Debit the withdrawals account $2,000, and then credit cash $2,000. Because if you credit cash, you're taking $2,000 out of the cash account for a vacation. So cash account, withdrawals account. So let's see what the next one is. Let's try. Okay, so let's say Shirley Cosmetics pays cash expenses. Shirley Cosmetics pays cash expenses. She paid $400 for rent. $400 for rent and $100 for utilities. So Shirley Cosmetics paid $400 for rent and $100 for utilities. So it's definitely gonna have to come out the cash account. So cash account, and I would say expenses. So 400 and 100 makes 500. So we do it like this. We just put it here: 400 coming out the cash, and 100 equal to 500. So we want credit cash 500. So we always credit on the right for decrease. That means money coming out of the cash account. So cash is an asset account. We're not increasing it, we're decreasing it. We're decreasing the cash account. We'll credit on the right 500. And then we have expenses. So expenses are 500. So we want to debit on the left for the expenses. That's 500. But we have 400 for rent and 100 for utilities. So we have a cash account and an expenses account. Expense account. So we don't call it utilities. We don't call it the utilities account. We call it the expense account. So we have the cash account, the expense account, and they also have salaries, payable accounts. You have salaries payable, and you have accounts payable, salaries payable. So let's see what we have next. Okay, you have a business. You have, in other words, Shirley Cosmetics, and I sold $1,000 worth of supplies to another company. So I always do 2 accounts. It's a nice thick chalk. I like this. This is that outside sidewalk chalk. You know, I had a whole box of these, but okay. So I sold office supplies to another company, $1,000. So if I sold office supplies, let me go with cash and office supplies. I sold office supplies to a company, cash for cash. So if I sold office supplies, that means I brought in some cash. Office supplies for a company. I sold office supplies for $1,000. So I'm increasing my cash. So I'm going to debit my cash account. Cash is an asset account. I want to debit my cash account $1,000. So office supplies, if I sold office supplies, that means I'm going to decrease my office supplies. So I'm going to credit my office supplies $1,000. Now see, if I was buying some office, if I was purchasing some office supplies for the company, I would debit because I'll be increasing my office supplies account. But since I'm getting rid of some office supplies, I'm going to credit on the right $1,000. So the office supplies is an asset account. Cash is an asset account. So that's that one. So like I said, I'm not an accounting teacher. I did take accounting straight at university, and I just want to show you the basics, debits and credits, and then, so it's good to, review the terms, accounts receivables, accounts payables, revenue accounts, service revenue. You also have accrued expenses, salaries payable, all your payables, all your receivables, your cash accounts, your land, your building, all, you separate your asset accounts from your liabilities accounts and study each one separately. Then work on your T accounts. And then, it won't take long. It just takes some time, takes some studying. So let's see what the next one is. Let's try. Okay, it says Smith withdraws $1,200 for personal use. So let's say really personal use, that really shouldn't even come out the business bank account because you don't want to commingle your funds. You should have a business account and you should have a personal bank account. So Shirley Cosmetics LLC, and say for instance I want to take, it says that it was a withdrawal made. It was a withdrawal made for personal use. So that's all it says. It didn't say that it came out the personal bank account. So a lot of times accounting is tricky. But it says funds were withdrawn for personal use. But it didn't say directly that it came out the business bank account. But I'm going to do it this way anyway. So it came out so $1,200 out the personal bank account. So one thing I would say is it still will come under cash and withdrawal. So cash, $1,200 coming out of the cash account will be $1,200. Credit the cash account. Cash is an asset account. Cash is an asset account. Credit on the right hand side because it's you want to credit when you want to decrease. You're taking money out of the cash account. and not putting nothing in. So if we were increasing the cash account, we would debit on the left. But this time we're going to credit on the right, 1,200, because taking money out. And then withdrawals account, 1,200, debit on the left, or withdrawals account. And let's see what the next one is. We're almost at 50 minutes, so let's see. I think that, let's see what else I can find. Decrease in asset and decrease in liability. Okay, let's try something different. Okay, this says, decrease in asset and decrease in liability. Okay, the question says, decrease in asset, and decrease in liability. Okay, let's decrease in asset first. Okay, so we have an asset. We might not need but one because this is a different type of question. Okay, it says decrease in asset. Let's decrease an asset first. Okay, first let's see what an asset is. Okay, we have land. Let's try land. We might need two because land, let's say for instance the land account is, say for instance we have land worth 100,000. Land is an asset account. So how will we decrease this? So we would decrease this land account. We want to go down. In order to decrease that land account, we probably would have to sell it. In other words, we own the land. We own this land for 100,000. To decrease that land account, we probably gonna sell it. That means we want to decrease that land account. Let's say, for instance, we want to sell it for. We can sell it for. Let's sell it for 150,000. Because we're trying to make a profit. So the land, we purchased the land for 100,000. But in order to decrease our land account, we have to get rid of it. We want to sell it. So we want to debit our land. So actually, we don't want to debit on the left. No, in order to decrease our land account, we want to credit on the right. Has to be on my P's and Q's. Okay. Debiting on the left, this just giving us the ownership of the land. Land is an asset, so it's worth 100,000. But for us to decrease the land account, we want to sell it. We want to get rid of it. That decreases the land. Credit the land account 150,000. I want to sell it. I want to decrease that. So it says decrease an asset. So that's how you would decrease an asset. And the next part of the question is, now we want to decrease a liability. Let's see how we do that. Decrease a liability. So we want to decrease a liability. First of all, we want to create a liability. Then we want to show how it is decreased. That's what the first thing is. Decrease a liability. First we have to see what the liability looks like. Let's go with accounts payable. First of all, we got accounts payable. Say for instance I created you a company, or my company, Shirley Cosmetics. Say for instance I created an accounts payable for $10,000. when I increase my accounts payable, I have to increase it first before I decrease it. So in other words, I credit on the right hand side. This means I created. So in order to increase accounts payable, you have to create one. So in other words, I purchased some supplies from another company, $10,000. $10,000 worth of office supplies on credit. So I want to credit accounts payable 10,000. So now I want to decrease my accounts. I want to decrease my liability. So in other words, I increase my accounts. I increase my liability account by purchasing some office supplies. That made me increase my liabilities account. But I want to decrease my liabilities account, accounts payable. So by decreasing it, I want to pay on it. So we have $10,000. I created my accounts payable, my liabilities account, by purchasing office supplies for $10,000. But now I want to pay on that. Say for instance, I paid $5,000. Say for instance, my accounts payable was $10,000. I created my accounts payable. I bought office supplies for $10,000. So I increased my accounts payable. Now I decreased it by paying $5,000 on it, in which it only give me $5,000 left. So that's how I decreased my liability. I started out with $10,000 worth of office supplies. That is how I started in the beginning. I decreased my liability by paying on my accounts payable liability and brought it down to $5,000. So I decreased it. That's how I decreased it. So those are, so I decreased it by paying on it. I started out owing $10,000 because I purchased some office supplies for $10,000. So I started out owing $10,000 on my liabilities account, but I decreased it by paying on it. I paid $5,000 on my accounts payable account. I decreased it by paying $5,000 on it, so my balance is $5,000 left. And I started out with $10,000, so I decreased it. So let's see what the next one is. Increase in asset and increase owner's equity. Well, I already did increase in asset. I did increase in asset. I did that. I think I just did that one. Increase in asset and increase in liability. Okay, let's increase an asset and increase a liability. So we want to increase an asset. Let's increase an asset first. First of all, let's try asset. Say for instance, the asset is cash. We have an asset cash, and we have $30,000. God damn. Shut. You hear about that? Okay, now. So I said we want to increase an asset. So we start out with our asset 30,000, and we start out with an asset 30,000. We want to increase an asset. So increase my asset cash. I want to deposit 50,000 in a business bank account. That gives me 80,000. I just increased an asset. I increased my asset cash. That's how you do it. We have 30,000 in the business bank account, in our cash account, Shirley Cosmetics LLC. We have 30,000 in there. I deposit 50 more thousand to invest in my business. So they give me 80,000. Debit on the left for increase. When it comes to an asset, debit on the left for increase. So that's how you increase an asset. Or it could be cash, it could be land. You have a land account. So let's see, I'll do a couple more. Let's see, increase one asset, decrease another asset. Say increase one asset, decrease another asset. So we can increase one asset and decrease another asset. Increase one asset, decrease another. So let's go with building. Let's go with building. So I want to increase my building, my land, my building. Let's increase our building. Okay, say for instance the building is worth 50,000. So we increase one asset, decrease another asset. So building is an asset. So in order to increase my building, I could probably let's see, we have a building, let's purchase another building. Another $50,000 building. So I increase my building account. I purchase another building that increases my asset account building. That's 100,000 now. My building account is worth 100,000. So now how can we decrease? Now decrease another asset. We can we can do cash. So that way we can decrease our cash account by paying cash for this other building, which is $50,000. So we credit cash 50,000. That's how we do it. In other words, we have our building account. We already have a building worth 50,000. So in order to increase our asset account building, we purchase another building for 50,000. That gives us $100,000 in our building account. Our building would be worth $100,000 now. And since we took cash and paid for that second building, we're gonna credit cash 50,000, which decreases our cash account, which is an asset. Cash is an asset account. We decrease our cash account, which is an asset account, by 50,000 because we took 50,000 and purchased this other building. So that's how you increase an asset and decrease an asset at the same time. So that's how you do that. Okay, so let me see. Decrease an asset and decrease owner's equity. Okay, so one more. Let's decrease an asset and decrease an asset, and we want to decrease an asset and decrease owner's equity. These are kind of fun, you know? We want to decrease an asset and decrease owner's equity at the same time. So you got two T accounts. So decreasing an asset means making it smaller, making the amount less. So decrease an asset. If we want to decrease an asset, let's start with cash. We got a cash account. We want to credit cash for decrease. Say for instance, cash is, we have 100,000 in our cash account, but we want to decrease our cash. Let's decrease our cash by 50,000. We want to take 50,000 out to buy some office supplies. So now, how do we decrease our owner's equity? So decreasing our owner's equity, we might not want to do office supplies. We could So making our owner's equity less. I mean, it still will make our owner's equity less because if we take $50,000 out of our cash account, it still can make our owner's equity less. So that means we still have to take 50. We still could take 50,000 out of our owner's equity account. So we have $100,000 in cash. We want to decrease our cash by crediting the cash account by 50,000. So that's decreasing our cash account, which is an asset account. And then we take 50,000 out of the owner's equity. So we want to debit the owner's equity account, take 50,000 out. So we are decreasing owner's equity. We're decreasing owner's equity, and we're decreasing the cash by 50,000. I think that is the last one. I'm at an hour right now. I think that is the last. Okay, let me just do I'll just do two more. Pay $300 cash to purchase office supplies. Okay, it's a business, let's say Shirley Cosmetics or Johnny's t-shirt business. Pay $300 for pay $300 cash for office supplies. Some of these are real simple. So we pay $300 for office supplies. So we have a cash and office supplies. So pay $300 or credit the cash account $300. And since the pay for office supplies becomes your asset. So that's debit office supplies $300, credit cash $300. So cash is an asset, credit an asset account for a decrease, and we want to debit office supplies for increase because we gained in some office supplies. We paid $300, and $300 came out the cash account. So that's that one. And I think I'm gonna stop right here because I'm at an hour. But this one I wanted to go over some. Just thought I wanted to go over some debits and credits. And let me see what else we have. And maybe next time I may do like a balance sheet and a balance sheet and an income statement. And we have a Graph received $80,000 cash from his former partners in the law firm from which he signed. Resigned. He resigned. He received $80,000 cash from his former partners in the law firm. So if he received $80,000, this probably gonna be the last one. He received $80,000 cash. So if he received $80,000 cash, excuse me. So remember when you when you have an asset account. You want to debit on the left for increase. So he received $80,000 from the company for which he resigned. That's $80,000. So if he received that cash, I would say that would probably have to go into owner's equity. It's a Grant received $80,000 cash from his former partners in the law firm from which he resigned. So a partnership for 5 years after graduating from law school. Recently, he resigned his position to open his own law firm. Oh, okay, he operates as a proprietorship. Oh, okay. Recently, he resigned his position to open his own law office. Okay, he deposited, $60,000 in a new bank account entitled, okay, I see what he did. Okay, he received $80,000 when he resigned, and then he took $60,000 and deposited into his own bank account for his own law firm. So That would go like this. This is just showing you what he received from. He received 80,000. Let me do this way. Hold up. This is gonna be the last one. Okay, he received 80,000. Let's do it like this. He received $80,000 from the law firm for which he resigned. But what he did, he took 60,000. He took 60,000 and put it into his own law firm. So let's do 60,000. With a debit cash, 60,000, and then owner's equity, 60,000. That's how he did that. So he receives 80,000, and he put 60,000. He started his own law firm because he resigned from this other law firm, and he took. They gave him 80,000, but he took 60,000. So he wanted to put that in his cash account. So he wanted to debit the cash 60,000, credit owner's equity 60,000, and then he had 20,000 left. So don't know what he did with the 20,000, but he put 60,000 in the business bank account, started his own law firm. So I think I'm gonna stop right here. I want to say thanks for joining me today, and just want to go over a few debits and credits. Thanks for joining me. Glad you could be here. Glad to see you. Glad you could be here. Glad you could join me. And, comment below, subscribe below. Just wanted to go over a few little, accounting transactions. Wanted to, explain what accounting was, comment below, subscribe below. If you have any ideas on what you might want me to talk about in my accounting, I will call these tutorials, subscribe below or comment below anything you want me to talk about in my accounting tutorials, or my Shirley Cosmetics. I would say business entrepreneur series. My business segments. Anything you want me to talk about on those, always comment below. Send me an email. ShirleyCosmetics@yahoo.com. I spell that CHERLEYCOSMETICS@yahoo.com. Shirley Cosmetics at yahoo.com. So I want to say thanks for joining me today. Glad you could join me, and like I said, learn the basics. Accounting, it's good to learn. That's how I learned. I was kind of leery about accounting when I first started taking it down Strayer University, where I obtained my bachelor's degree, Strayer University. I didn't know anything about accounting, but sometimes when you have a good teacher, because I know my first teacher, I didn't do so well. I think I got a low grade. I ended up taking it over, and I got a different teacher, and I got an A. So I studied and studied and studied because I was determined to learn accounting. And my husband, he worked with me, set me down at the table. I remember I still remember that day he set me down at the table, worked with me with my accounting, and I came through with flying colors. And sometimes they just take that study in, so they'll never say you can't do nothing. Because I took business law, accounting, logic, them 3 courses right there. Never even knew they had a course, like those, title those, with that type of title, accounting, logic, and business law. I really didn't know too much about that, but I went there and I took that and got a B. Took accounting again and got an A, and took logic. I took logic and got an A. So, I remember that course vividly, and so I want to say thanks for joining me today and work on your basics. Check out some of these other YouTube channels that may be, maybe more a little, maybe a little more, their lessons may be, I guess I would say, taught a little different than mine, but, I always like to I like to teach my little tutorials on my T accounts, because I think it's easier to learn accounting through your T accounts. You learn first of all, you learn what accounting is, you learn about who needs this accounting information, your creditors, your debtors, your creditors, your SEC, Security and Exchange Commissioners, your auditors, Your banks, your credit unions, other businesses, need this accounting information. Then you want to learn that, find out that, study that, find out what accounting is, who needs the information. Then learn all about your revenues and expenses and accounts payables, accounts receivables, your cash accounts, salary payable accounts, uh, interest revenue, all the different accounts. Learn all about those, and then learn your debits and credits. Which accounts do I increase on the left? Which accounts do I increase right on the left, and which accounts do I increase on the right? It's an asset account. It could be an asset account, or it could be a liabilities account. Because I'm still learning, I'm still studying. So, but thanks for joining me, and I hope to see you on my next video. So, like I said, comment below, subscribe below, and you have any ideas that you have for me, if you have something in particular you want me to talk about in my accounting course, comment below. So I'll be glad to look over those comments. Subscribe below, and give me some ideas of what you might want me to talk about. In my Shirley Cosmetics entrepreneur segments as well. And also in my accounting segment. So I probably will be doing both. I'll be doing from time to time some accounting segments, maybe some cooking segments, and then my entrepreneur segment. But thanks for joining me today, and I hope to see you on my next video.